Another episode of Going Live with Good Soil. Emmett is off this week. He's traveling, so we are pleased to be joined by Yashu Sharma. Yashu, thanks so much for joining us.
Honored to be back. Thanks, Matt.
Yeah, my pleasure. Before we jump into it, for those listening on Twitter Spaces, just a reminder of some disclosures. This is not investment advice. Yashu and I are just giving our own opinions on things. None of this is financial advice or investment advice of any kind. So please do your own research and make your own decisions. We're again just doing this to try to open source our research and our thinking as much as possible. So with that said, let's jump into some macro market news. I think the big development lately over the weekend, Yashu, was there was all this kind of pressure for the Build Back Better bill. We need a couple more B's in there, I think, to make it just more ridiculous. And then Senator Manchin came out basically saying he was not going to vote for it, and so the bill's potentially scrapped. Maybe it'll be passed in some different version next year. Markets obviously crashed pretty hard yesterday, continuing a stream of red in December. What's your take on how big of an impact, if any, that Senator Manchin's reticence here is impacting markets?
Yeah, it's interesting. I mean, on one on one side, I'm kind of torn, right? Because I think the EV credit disproportionately helps legacy auto, and we've had this conversation
Mhm.
before. How we think it's kind of make or break for them to have this credit in order for them to even turn a profit. On the other end, I do think when with macro uncertainty like that, or when something gets priced in to a degree, I think towards the end of October, middle October, and November, I think we were seeing a lot of this kind of being priced into the markets. Well, okay, this is going to get passed, and then there's going to be this much more economy growth based on this, or inflation's going to dampen based on this, and we talk about legacy auto and how I guess they were kind of projecting for this to happen. Tesla started raising prices, I guess, in anticipation for this. And so when this kind of gets last minute torn up, I guess that brings some sort of level of uncertainty to the market where, now people have to revisit their thesis a little bit, maybe pull back. So in the shorter term, I guess I understand why, there was a broader market pullback. Legacy auto, Tesla has been kind of ripped up since then as well. But in the long haul, I mean, if we want to talk about EV growth, Tesla doesn't need this EV credit, whereas legacy autos, like I said, do. So, yeah, a little bit on both sides on my end.
Yeah, the funny thing to me is ahead of this, I think everybody was expecting the bill to pass this year, and markets were falling kind of in anticipation of this because they're saying, okay, you've got so much federal debt, and this is going to only kind of increase the deficit spending, and so the government's going to have to print more debt, and then that's going to cause kind of inflationary pressure. So you had a lot of kind of macro concern on the monetary policy side related to kind of interest rates rising, which of course hurts growth stocks. So it's kind of strange that markets were falling on that concern. And then if you're concerned about that, you should really not want the bill to pass, right? Because that stops kind of deficit spending from increasing. And so you've got the potentially not the entire maybe remedy is too strong of a word, but you've got something of a remedy for interest rate rising concerns by not having so much government spending. And then at the same time, the markets fall because they kind of want that that extra little gasoline on the economy and things really priming it. So it's kind of confusing to me, or just strange that markets are falling kind of on both sides of this line, this tightrope walk that the federal government's been pulling here.
Yeah, that's a great way to put it. I think what economists were saying, and again, as someone who studied economics, you can ask three economists for an answer, and you'll get five different answers, right? But I think I think kind of the concern here, or I guess what they're hoping for was with the BBB, the velocity of money was going to increase. Now all of a sudden, yes, there's more money out there, but how often it interchanges hands was going to increase. So it's we're in this kind of predicament at this point where All classic theory is out the window. No one really knows. It's unprecedented territory where we're sitting at with how much money is being printed, with cryptocurrencies now on the forefront of everyone's mind. And it's interesting and super cool to be a part of this generation of investing, but it's also kind of concerning because we don't have a roadmap of what's kind of ahead as well.
Yeah.
So and with more money than ever kind of entering the markets, and the amount of, like, the amount of fiat, the amount of M1 M2 in the market is just, it's absurd. But if you look at where that money has to go, it has to go somewhere. It's not going to be sitting around. So these are questions that I think no one is prepared to fully have to grasp all of the nuances of, and figure out every single answer to a T. But I guess that's what makes our kind of videos exciting, is because we can hypothesize on these sort of things.
Yeah, absolutely. It's an exciting time. Couple quick housekeeping notes for anyone who's listening on Twitter Spaces. Yashu may be sharing his screen at some point, so you may want to hop over to YouTube. We'll do our best to kind of explain what's going on verbally, so you can hear that. But if you do want to see any screen shares, hop over to YouTube. And then just a reminder, if you have any questions or topics you'd like us to dig into, put them in the notes or put them in the chat, and we'll try to do our best to get to those. So Yashu, I do completely kind of agree with you that this is unprecedented territory. I've been thinking a lot about that lately, actually.
Hmm.
Even just kind of like my core finance 101, theory. I'm kind of increasingly just wanting to throw out the window. I mean, kind of like the bedrock of valuation and everything that I learned in school, and then as a practitioner when I was doing it, valuation work and investment banking work in the real world, was like the capital asset pricing model,
Hmm.
which has a couple key assumptions that I think are like don't almost not applicable to today. One of which is that like you need a risk-free rate to price any asset,
Hmm.
and basically U.S. Treasuries are that risk-free asset, which I think it's increasingly a tenuous assumption to say that there's zero risk of like a U.S. default or something like that. Now, granted, probably they'll just print more money rather than actually default, but I wouldn't call those securities risk-free by any
Hmm.
stretch. And then another one is there's this concept of the equity risk premium, which is how much have stocks returned historically. And so I remember when I was working in valuation, I would literally go to this book. I think it was like from the Risk Management Institute or something like that. It had every single monthly return from the stock market from like 1920 or something like that up to the current
Wow.
month. And so you would just average in the new month, and that would be your new kind of market return, and then you'd subtract the risk-free rate from that to develop your equity rate. But in looking at like the pace of technology and the stuff that Tesla's doing, and like the potential advent of artificial intelligence to kind of drastically increase productivity, and I would suggest the return profile for um, some winners in the new economy, it seems likely to me that returns from the past 100 years will be a lot lower potentially than returns in the next 100 years. And then if
Yeah.
that's true, then that like that whole capital asset pricing model is like almost thrown out the window. And so you've got this new paradigm that's uncharted, and you'll need new formulas and new kind of theories to survive in this new world. Um,
Yeah.
but I haven't heard too many people talking about that. What's your take on things changing potentially in a way that's unprecedented and hard to really fathom?
You would definitely know more than I when it comes to the nuances and detailed calculations. But it's funny, like someone one day had created the CAPM model, and someone
Mhm.
had created, all these models that we talk about. And I guess we're getting a little bit philosophical here, but yeah, with new technology, with new paradigms comes new models, and your model is only good as your assumptions, right? And as we move forward, you're right. Something as, I guess, simple and basic to maybe people like us watching, or I guess maybe a little bit more, I guess, looking basic, is crypto, right? For example, we, I guess,
Mhm.
get crypto. Obviously we don't get all the nuances of it, but we understand crypto versus,
Mhm.
let's say, like my grandparents. And so, right, like my grandparents in their age would have that model, and now you're saying, there's all these new variables that enter the markets. It's going to be interesting. And we're in this, it's probably the best time to probably go through education and then come through on the other end and see how different things is. That was one of the experiences I had, was like the, I guess the stark contrast between what's taught and what the real world models are actually dictating, is
Mhm.
that delta has probably never been higher than it is now. So to a degree that's almost beneficial to you, because you kind of get hit in the head with like, listen, this is not worth the paper it's written on. But that in and of itself might be the learning experience for a lot of people that go through, or even teachers and professors that as they teach today. So yeah, it's interesting times ahead.
Yeah. Yeah, that's a really interesting comment. I mean, I had I remember I was taking when I was doing my MBA, I had a professor who was a like a finance PhD, and so he would have us model all these companies, but he would spend zero time like talking about the operations of a company, and he would spend all
Mm,
his time about like, okay, you need to update with today's like the current cutting edge like debt rate, and so like pull here's how you pull like this very specific like piece of data, so that your formulas are like theoretically correct and perfect. And it was like I was like, so much, yet there's such like a lack of wisdom in how you're kind of applying it. Like it would be impossible for him to generate alpha, I believe,
mm,
because he was taking no time to really understand like the companies that he was valuing. I mean, it was really just an academic exercise in the most
mm.
literal
Yeah, yeah.
sense of it for him. And it's I think the edge that you're going to have in today's market is really on the information side, and kind of seeing around the corner to what's going to be the trend 5-10 years from now. I think it's going to be
Mm,
much less on, oh, I bought something that should be priced at 102 and I picked it up at 101, so I'm like
mm.
I'm going to generate alpha. I don't think that's going to be like a long sustainable advantage in today's market.
For sure. And that ties into I had kind of had this thought last week. I was passing by a hospital, and I was looking at a couple of nurses outside smoking. And I kind of had, and to be honest, I think one of the highest smoke rates per occupation is nurses, because how stressed they are.
Hmm.
And I had this realization where it was kind of analogous to investing, where I guess the person that maybe knows the most, understands the most models, can hypothesize the best, doesn't always make the best investor, because
Hmm.
just because they know doesn't mean they translate into what they act on, or how they act emotionally, let's say. And I kind of had that realization where it's like, I guess knowing and being able to understand is not the same as being able to just like you said, generate alpha in the market. So,
Hmm.
some lesson there in there for me, kind of my brain hits me with these random thoughts every now and then. And I was like, well, something to think about there, because, obviously the nurses know best. They see, cancer patients, people coming in with that have been smoking their whole lives, yet they're out here smoking on their breaks, like chain smoking. What's the kind of chasm here that we have to cross? So yeah, I mean, there's something there.
Yeah, it is funny. I mean, I remember I had a doctor's appointment one time, and my regular doctor wasn't there, and so I had just like this other doctor who was like incredibly obese, and he was asking me about my diet and if I was taking care of myself, and I was like, "There's nothing wrong with your questions, but you do have a bit of a credibility issue when
Hmm.
like you're not necessarily practicing what you preach." So
Yeah.
it's kind of interesting. So think speaking of markets, obviously December's been rough. I think one of the things I haven't heard people talking about too much is, kind of the potential for window dressing and some tax loss harvesting and that sort of thing. What's your take on to what extent that factor is playing into the markets here, and as we get into late December?
So to begin quarter four, I think October 1st, Tesla opened at 778-ish bucks. Don't quote me on that exactly, but I think it's close enough. So as Tesla sits here at 907 right now as we talk, there's some alpha to be generated there. If you're a fund, let's say, out there that hadn't have bought in Tesla or sold Tesla prior to quarter four, and wants to show that hey, we were holding Tesla. Hey, look at us. We generated we generated a couple $100 worth of alpha here, let's say, or $150 worth of alpha by the time it's all said and done. So I think after quadruple witching is usually when I start talking more about window dressing being more of a factor, just because a lot of the funds rebalancing is kind of out the window now. We don't have to worry about that. Contracts have been rolled when it comes to futures, and now funds can go, okay, towards the end of the year. And this is kind of the quarter where I kind of question it a little bit more than usual, just because it's holiday season. I just wonder how many funds are out there actively trading. Maybe they're going to trade in the next couple of days here and then just sign off for the next week or two and go to the Hamptons. So, there's probably some degree of kind of window dressing to be had here. And perhaps that's what we're seeing today with Tesla up 1%. But that being said, it's still underperforming based on the market. So, you know, who knows kind of what's to happen here. There is, I think, some weakness as well based on Berlin and Austin, well, mostly Berlin, with how it keeps getting delayed and it's not really sounding very confident on an exact date that they're going to open. So perhaps there's some waiting and seeing around there. But I think with the that has been generated by Tesla from the beginning of quarter four to now, I think it's probably it's probably a decent enough chance to hypothesize that there's going to be some degree of window dressing if it hasn't happened already. What do you think?
Yeah, I think you're right. I mean, it's a lot of these funds have disclosures that are kind of based on quarter end, and so I think there's a decent amount of rotation that happens, especially late in the quarter to, kind of give the message that you want to give.
Mhm.
The other thing that does tend to happen, especially this time of year, is tax loss harvesting. We've done a little bit of that within our own fund. Just kind of selling some of your losers to lock in, or to realize the losses. In order to kind of minimize tax impacts for your investors. So, that could be happening. It probably makes less sense with Tesla since it's been up so much on the year. But you could imagine, if you bought in at 1,000, or for some of the other growth stock names that were up a lot more earlier, like Square and Zoom and some of those other ones, yeah, certainly there could be a decent amount of just kind of selling. And it appears to me, Emmett and I have talked about this a couple times. It seems like there's some cash kind of sitting on the sidelines. So maybe some
Yeah.
people are kind of harvesting some losses, and they're not immediately redeploying that to other investments. It doesn't seem like it's been a sector rotation sort of
Yeah.
sell off. It's been more just a kind of broad market based sell off.
Pullback.
Growth stocks
Yeah.
obviously having been hit the hardest, but it's not like you've seen some kind of huge rise in consumer products or industrials or something like that.
For sure. And I agree. I think with the new variant and people kind of questioning, okay, are we, even though I think we're far and away from where we were in March 2020, I think people can't help to have some PTSD, investing wise, at least around that, right? With how much
Yeah.
uncertainty there was. And it feels like here in Canada, we're, kind of semi locking down again. And it sucks to hear and all this sort of stuff. So I think you're right. There's a degree of just pool of money that's waiting for like a huge amount of blood on the streets before they're going to come back. I wonder if the numbers in the variance in terms of hospitalization rate with our vaccination population being so high and it being lower, hopefully in the next couple of weeks we get some more sanity in the market and realize, okay, well, it's not going to be nearly as bad as, let's say, even Delta or 1.0 was. So, but I agree. The question I have is when it comes to Tesla and tax loss harvesting, I just question how many people have bought into Tesla over 1,000. Like
Yeah.
it probably doesn't have to be a lot. And I think the person or the funds that were buying Tesla with the huge volume that we're seeing a couple weeks back, uh, they're probably diamond handsing the position anyways. So I wonder how much retail would have bought in Tesla above, let's say, even $900.
Yeah, probably not a whole lot. I mean, it doesn't seem likely that a bunch of folks who bought in, say, late October or into November, are all of a sudden selling to
Yeah.
harvest some tax losses. Yeah, undoubtedly, there's a little bit of that, but it doesn't seem like that's kind of the primary driving factor to me of what's going on with this price movement. Um,
Do you
you know,
think Elon? Oh, sorry. Go ahead.
yeah, no, well, yeah, that's a we should kind of talk about that. Is he done? That's what everyone wants to know, right?
Yeah. Yeah.
I,
And yeah. Go ahead. Your theory first.
I think he is, at least for this calendar year. Gary Black's been talking a lot about his kind of use of discretionary sales and kind of when that lockup period would end. Seems like that was probably last week, and then he comes out over the weekend giving a specific number of how much he's paying in taxes. I think it was $11 billion. So to me, it doesn't
Hmm.
seem likely that he would quote that specific figure if
Yeah.
he was potentially going to be selling some more shares, or at least didn't know the exact number of shares that he was going to sell and at what price. So I think the most likely explanation is that he's done, at least for calendar 2021. What do you
I
think?
agree. That's exactly what I thought was, why would he tweet that if he had more to sell? Why not just wait and then say, hey, I've sold 12 billion this year. So it does feel like either he's done or he knows when he'll be done, and it'll like today I was seeing some comments on Twitter, people saying it really feels like Elon was selling this morning. And to a degree it does feel like it whenever we get ripped off the top on a green day. I think everyone's immediate reaction is, okay, Elon is selling. So perhaps I think he's, if he's not done, he's obviously, goes without saying, he's really close to being done here. I think if I'm Elon, I want to sell everything this fiscal year. First of all, the tax
Mhm.
rate's going to go up next year, but on top of that, you get kind of bragging rights to be able to say, in 2021 I sold this much. If you spread it out, laymen, that are going to write articles aren't going to be able to give him that much credit versus just
Yeah.
bunching it all together.
Which he's clearly interested in, right? Like he's clearly punching back at Senator Karen. He said like so Senators Warren and Sanders, that have been kind of
Yeah,
making him their the poster child for kind of the fact that they use the word freeloading is it's like kind of
ironic.
hard to
Yeah,
fathom.
yeah,
But for what right or wrong, they're criticizing him, and so he's got a very tangible data point to say, "What are you talking about? I'm the biggest taxpayer in U.S. history.
yeah,
I've or not donated, but I paid 11 billion to the Treasury this year. So what to you is a fair amount? My tax rate's over 50%. What's the right number to you?" So
yeah.
it seems clear to me that he is interested in kind of having the data points to fight back from these personal attacks. So I think it even goes to the fact that he was selling his houses earlier this year and that sort of thing.
Yeah. Yeah. I really don't. I think Elon really takes those kind of narratives personally, which
Mhm.
he has every right to do. Uh, I consider all of this kind of a sideshow to what's happening with Tesla. Yes, Elon selling does contribute to downward pressure on the stock and all this stuff, but if you zoom out 5 years, if you zoom out even a couple of years, like this stuff is going to be non-material, I think, to the narrative of Tesla and how fast it's going to be growing product wise. So, it's kind of dominating whenever we get into these narratives in a shorter term basis. And over the summer or over the spring, early summer, it was, remember that FSD accident, article
Yeah.
after article. Whenever we get into these like shorter term narratives that have, let's say, no longer term effect on the stock, like Elon selling, or these kind of political stories going out, I always try to remind myself, and it's hard because I kind of get into the hole myself, but try to remind myself, like, zoom out, think bigger, what's happening with the company. And I just can't stop thinking about Austin and Berlin. Like, as soon as they're online, as soon as they're producing cars and delivering, whenever that will be, that's gonna be the big catalyst. So yeah.
Yeah, I agree. I mean, so last week on our live stream, we've been talking about these same topics for a while now because I mean
Yeah.
it's been so dominant, right? I mean, we've had a very precipitous fall in a very short amount of time, so it's kind of natural to talk about kind of the short-term movements in that environment.
Yeah.
But last week we kind of hit pause on that and kind of shared our estimates for fourth quarter earnings per share and kind of a lot of the uh, operational just catalysts or I mean the reason that we're investors in the first place, it's not because of short-term market issues, it's because of the core operations of the company. And I think the
Yeah.
story there is so strong and is going to be so positive that I really am just like I'm more and more convinced that we need to kind of um, close our minds a little bit to the kind of short-term pain. Don't check your account balances on a day-to-day basis, and more so just kind of focus on the operations and what you think the company is doing to execute.
For
Um,
sure. And it's definitely harder because, if you have options, if you have leaps, or if you have stuff that's expiring January, February, March, April, May of next year,
sure.
you're going to be watching that like a hawk. So, but, you're totally right. You got to zoom out in times like this, buy yourself more time. At least that's what that's what I'm considering. I've been rolling stuff out if I can, to buy myself some more time, especially with the macro markets being so uncertain. You just don't know how long this can drag on. And we've seen it in 2021 with how far
Mhm.
Tesla got kind of dug through the mud, especially in spring and summer of this year. So
Yeah, it is. But then again, like Q3 came along and people had to kind of revalue because they said, okay, Tesla's operations are stronger than we thought they were. They're, more profitable, more cash flow positive.
Yep.
We give more credibility to their demand story. I mean, 12 months ago, nobody thought they'd actually grow, like 50% per year compounded for a decade. And now you're seeing like markets starting to give credit for that. A lot of the suppliers are starting to do that too now, where, people wouldn't take Tesla seriously when they said they want like as much nickel as you can provide, or, whatever the, supply chain constraint was. Tesla was
Yep.
just saying, we'll take whatever you can supply us with. And that was kind of a joke, definitely 18 months ago, and even to a lesser extent,
Better
12 months
day.
ago. And now there's just much more credibility. I think more and more people are realizing that, okay, EVs are going to dominate, and Tesla is the best EV, at least, here in the US,
Yep.
and probably worldwide. So
Yep.
I do think there's a bit of a shift in narrative. And then the fact that they've been able to do it so profitably, it's like that's surprising
Yeah.
everyone, even a lot of the bulls out there.
30%, 30 greater than 30% gross margins, 14% operate. Like it was when the report came out, I almost didn't believe it, but I was like, this is what we're talking about, right?
Yeah.
So and to be fair, we're not expecting that same level of gross margin in quarter four. Zach said as much on the call that don't expect margins to be that high in quarter four because of the ramp of factories and the costs going there. But again, if you zoom out 2 more years from now, what are we talking about with gross margin then with a 4680 battery cell production? So
Yeah. Well, there was that report from, was it Deutsche Bank? I think had Martin Viecha out for a day or two this
yeah.
week. They just posted their report this morning, and I think they were talking about 20% operating margins as like the long-term target,
Hmm.
which is kind of crazy.
Wow.
Um, so like if that's true, and
Wow.
I think there's every reason to believe that that could be true based on Tesla's kind of manufacturing prowess. And you imagine when like Berlin and Austin are kind of running at full capacity, and you're producing Cybertruck, which is like this kind of radical design philosophy, which is going to minimize costs, and you won't need a paint center, and like all these things, and then you're kind of amortizing OpEx over 3-4 times the number of vehicles. And yeah, it's like, okay, I could see
Yeah.
um, operating margins being that high, and a little tick in full self-driving take rate will go a really long way as well to kind of financial
Yeah.
performance of the company. And that's something that I think many people haven't really thought through, but it's like a huge catalyst if they could raise that by 5% or 10%, let alone like double it or something. So
Oh yeah.
it's
Yeah.
I'm really excited. um
Absolutely. We're talking like tech margins at that point. Like it's
yeah,
crazy.
yeah.
So I mean, we're
Which just
almost
like,
talking about that. So
they used to get criticized for that. And that was kind of the way I thought about Tesla as an investment was, okay, sure, manufacturing's hard, but they'll have these tech-like margins from full self-driving. Well, what's happened in reality is they actually proved that they're better at manufacturing than like the traditional auto OEMs, which
yeah.
like nobody was predicting. So they've
Right.
got like higher gross margins than they do. And then on top of that, you've got this optionality potential for tech-like margins on the software. So it's um,
Yep.
yeah, in the long term, I think you can't help but be incredibly optimistic. And um, yeah, I only wish I had more dry powder personally.
Yeah, I know. There's one note actually on the Deutsche Bank note that I saw. Point number one of the last points. It was around FSD and how they think one of the bigger catalysts coming up sooner rather than later might be the rollout to all American users for full self driving.
Hmm.
And I just had a question about that to you because you talk about you talk about bringing deferred revenue into the equation. Uh, should they roll out FSD? How much deferred revenue ballpark? I forget now. How much would they be able to bring into their income statement?
So it's the total deferred revenue balance is several $billion, but I've done some estimating on the portion of that that's attributable to just FSD, and I think
Hmm.
that's around 1.7, 1.8 billion dollars.
Okay.
And so you'd have to imagine that that's globally, but most of that, because most of the sales and then the higher take rate is in the US. So we don't know. We don't have the data for like the exact number, but I would imagine it's probably north of $1 billion would
Hmm.
be recognized if they did roll that
Wow.
out, US wide.
Wow.
Um, Now the analysts are probably going to back that out because they say, "Oh, that's only like a one-time boost and yada yada yada." And I like my point of view on that is, okay, well, if you're going to back that out, then you need to add it back to historic quarters, because it's not like that was like a gain
Priced
on
in
like a sale of Bitcoin or something like that. Like it's actually um,
material.
material profits that are operational in nature.
Yep.
And so even if you just count like the incremental margin from FSD being 100% recognizable in the US, depending on take rate and like how many units you're talking about, but it's somewhere in the neighborhood of like $300 million per quarter of incremental margin. Just if, kind of current steady state FSD was
Mm.
100% recognizable instead of like 55, 58% right now. So that's
Mhm.
another big catalyst that I think most people aren't taking the time to model out appropriately.
I think there's also something to be said about take rate. Like, I think we're assuming take rate would stay flat, and then they would be able to, and then, right? But I think
Yeah.
if FSD gets solved and it gets rolled out, I think take rate is obviously gonna skyrocket. People are gonna want to subscribe, see if it's worth it for them. Presumably, if FSD is out, you'd assume some sort of robotaxi service in some cities might be out by then. So,
Hmm.
you know, and I guess it gets harder and harder to model, and that's why I guess a lot of people just focus on the auto business and just stay true to that and consider everything else. Like, some people in the comments are saying, like, just a lotto option on Tesla, and you kind of said the same on our previous streams before. Is you just consider it like options, like out of the money options, not robo
Hmm.
taxis, but let's say something more far out there. So
Hmm.
yeah, there's just so much, right?
Yeah, I do, and I do consider, like robo taxis as an option, but I think the full self driving, like that will be. You don't need robo taxis to recognize that under gap accounting. So
True.
that'll probably be in Q1, I would guess, based on kind of reading between the lines on that Deutsche Bank report.
Mm,
So if you got all that recognition in Q1, then like, you're going to have like kind of crazy margins. Of course, they'll get adjusted out, but then going forward, you're going to have that 200, 300, 400 million dollar plus FSD, yeah, impact, just
hmm.
assuming the take rate stays the same. But if all of a sudden, like, and I've been public about kind of my experiences on full self driving not being so great, but I
Yeah.
think before they do roll that out, it will be a lot better than kind of the current state of it. So if that gets a lot better and then it rolls out and then all of a sudden people everywhere are seeing like, oh my gosh, look at this technology. I can't believe this is like, you can actually buy this. Then I could absolutely see take rate going up. And the thing,
Yeah.
and another kind of hidden catalyst that I think many people aren't thinking about is that, full self-driving can just be purchased or subscribed to from the existing fleet of non-takers as well, which is like an order of
Right.
magnitude larger than any one quarter sales.
Yep.
So
Yep.
it's there are so many ways that the margins could just kind of go to crazy town. It's kind of hard to fathom, and I think they're realistic. It's not like, oh, moonshot, they could solve cancer and then they'll be like a like $10 trillion company. It's like
Right.
there are very reasonable changes that they're working on
Yeah.
that could drastically alter the financial profile of the company, and that's
Oh,
really
yeah.
exciting.
100% agreed.
Um, well, maybe we should open it up to questions. Unless actually, one other topic I wanted to talk about was so Berlin and Austin.
Mm,
Obviously we touched a little bit on Berlin being delayed. Seems like there's been some kind of quasi political issues going on there. But then one of the other surprising things which I think came out of the Deutsche Bank report also was just how expensive the Austin plant was. I think it was like a $10 billion price tag that was quoted, which is obviously
mm,
quite a large amount of money. But when you see how big the plant is, it kind of makes sense relative
mhm.
to what you saw, like with Shanghai, for example. So, what's your
Yeah,
take on kind of the timing of those, and when we'll get to kind of meaningful production at both
production.
facilities?
Well, Elon tweeted saying he wants to do like a grand opening party in Austin early 2022. So
Hmm.
maybe Elon time, let's say March. Okay. And so by March, you'd assume production, or yeah, you'd kind of be at the same point where Giga Berlin was when they did their Giga Fest. So you'd
Hmm.
assume that they'd be able to produce cars. And I guess reports have been coming out that they have been producing cars, production cars at least from factories. So yes, there is some sort of political risk or agenda there in Berlin. I think I've made a video about it yesterday. I think I got a lot of comments with people, throwing shade back at the German red tape. And I guess to a degree that makes sense. But I think still in the long haul, I think it's important to stay focused on getting this factory online and running. I don't think Germany was a mistake, albeit it's taken way longer than people have expected. Because I think in the long haul, the brand reputation that having a factory in Germany, having skilled engineers produce cars out of
Mhm.
Germany, I think in the long haul is such a boon to Tesla's brand. In the same way that we look at, all these German auto manufacturers today, and there's a good group of following of people that only trust German made vehicles. So
Yeah.
I think in the long haul, it makes sense. It's kind of the mecca of the auto industry in terms of like just high brand, high quality cars. And so, yes, I think it makes sense to kind of, I guess, hold your nose to what's kind of happening and kind of continue forward, albeit it's very hard considering how far it's been delayed. But again, it's fun. It's funny because now we've kind of come in this situation where we might see both factories come online like at the same time. And should that happen, like we talk about Shanghai when it came online and how much of a step change that was to Tesla's business. Two factories, two new age factories, albeit coming online at the same time. Talk about exponential growth in volume, right? We went from 500,000 cars last year to looking about let's say conservatively 900K this year. So it's an 80% year over year delivery growth. No new
Mhm.
factories, just Shanghai expanding, and that's it. And so we talk about Giga Berlin and Giga Austin coming online at the same time. Let's say in quarter one, coming online with the new age factories, like I've said, we already had an 80% growth rate year over year. I just don't know what to expect. Like, even the bullish targets I look at, I'm like, is that too bullish for 2022? And yeah, so it's going to be amazing quarter one once they do come online. It's just a matter of time. I've seen some comments as well, people saying, will it never come online? Will this be delayed for years? I highly doubt it. I think there's a lot of political pressure coming at them as well. So I think it's a
Mhm.
two-way street. And I also had this kind of semi conspiracy theory where Tesla built all of these built a lot of this factory on temporary permits, right? They went ahead, they
Mhm.
said we're not going to wait for these permits to come in, we're going to start building. I wonder if some of this backlash, red tape that they're getting now is kind of to set precedent for anyone else that might come in and say, "Hey, listen, you're going to do it our way, or we're going to end up delaying you to the time it was going to take, anyways," just to kind of set a precedent for people coming in.
Yeah, no, I could see that being the case. When you were talking about, choosing Berlin as being like the short term painful, long term smart approach,
Yeah.
it reminded me a lot of kind of the decision to own their own, dealerships essentially.
Mm,
So, there was a Tesla was not profitable. They were, losing cash flow every year in a drastic amount.
hmm.
And they still chose to go like this much more difficult, path of owning their own, dealerships and like up until last year, I think there wasn't even a possibility in Michigan where I live to take delivery. You had to go to Ohio to take delivery, and I think
Crazy.
in Texas it's still the same way, even though they're building a factory there.
Wow.
So clearly, Elon and Tesla have a penchant and an ability to say, okay, yeah, we'll do the harder thing in the near term, and we'll absorb the political pressure and all the pain associated with kind of doing something that hasn't been done before, because in the long run it's the right thing to do. And now, of course, it's such an advantage, and it's pretty much seen even among Tesla critics that it's an advantage that they own their own uh, you know dealerships
Dealership.
and essentially aren't beholden to them, don't have to give up margin. And you see what Ford is going through right now, where dealerships are marking up Mach-E's and kind of
Yeah.
hurting the customer relationship that way.
Yeah.
So yeah, I think you could definitely be right that the same sort of mindset is at work here in Berlin with kind of being willing to absorb an ungodly amount of political pressure to
Yeah.
do what they think is the right thing there in the end.
Going back to your original point about 5 or 10 billion, or 10 billion in this case for Austin to cost, it's encouraging to see how fast Tesla paid back their Shanghai loans, and
Mhm.
quite literally from the cash that they generated from that plant within the following year after. And when we talk about those factories ramping, I guess a blessing in disguise might be the fact that they've been sitting ready to produce for so long. Maybe the just the speed of what they're going to ramp at is going to be a lot faster than even Shanghai would have, because Shanghai came online, let's say, before it was fully run, fully done and ready to, be fully optimized for. Whereas Berlin has been kind of producing these production cars internally. I think Sawyer Merritt posted that they have was it like 200 or something Model Ys, or maybe it was 25. I'm totally off here, but it was more than a couple of dozen at least Model
Mhm.
Ys that they have produced in Berlin. So perhaps there's the blessing disguises that Wall Street is still going to price in these factories taking a long time to ramp. Whereas when these factories are sitting here and there's some employees optimizing these lines, perhaps once they do come online, they ramp way quicker than Shanghai had, which I guess would be,
Yeah.
massive.
Yeah, it's possible, and I think even the gross margin impact, I don't think is going to be that dramatic, especially for Q4. The depreciation and amortization is probably going to be the biggest hit, and that doesn't start until you're actually producing production versions of the vehicle. So even if they were starting, let's say today, they started kind of they said, all right, the factory's online, it's gone from like work in progress to PP&E in the accounting entry.
Right.
You don't depreciate for the whole quarter. It's only that those couple days. So of course there will be some gross margin pressure out of those, but I don't think it's going to be crazy or insurmountable. I remember there were quite a few people thinking in 2019 when Shanghai was launching that it was just going to be like this preposterous drag on earnings because they were going to have to
Mm,
depreciate the whole factory in 5 years, and it's like that's not
right.
what we saw. Of course, they were not as efficient as Fremont off the bat, but it was not like some like catastrophic drag on earnings as they got that launched.
Yeah,
So yeah,
for sure.
we'll see.
And I think moreover than even the accounting and depreciation costs that might come on is I think Wall Street is trying to see, okay, if Tesla, I think this is kind of like the next big thing that they're waiting to see is, yes, Tesla, made a factory in Shanghai and got it producing and ramped up really quick.
Mhm.
I think Wall Street is going, okay, we've priced that in. And now Wall Street's thinking, okay, this is a new age factory. Both of these are new age factories, new production lines for batteries. If and when Tesla, I think it's when Tesla starts producing and churning these vehicles out like no tomorrow, that's when I think Wall Street will go, okay, now all of a sudden it's just a cookie cutter model. If Tesla can take these same factories, Berlin or Austin speaking, and just, I guess Elon has said until 2023, they're not even going to think about it. But in the future, when you talk about production capabilities, those are the ones that are going to be scaled more than the Shanghai ones. And so as we move forward, I think that's the last thing that Wall Street is trying to, because I think execution risk is the biggest
Mhm.
in Tesla. I think, we talk about technology, they have the technology, they have the patents, although they're open sourced. I think execution is the big thing that Wall Street is waiting to see on. And yes, you can see drones and photography and everything getting built on the factories, and you can see the scale that they're being produced. And as us Tesla bulls, we love looking at that sort of stuff because it kind of feeds into our, hey, this is going to happen very soon. But I think Wall Street is trying to hold back and temper back expectations until they start seeing cars being put out.
Yeah, I think you're right. So as you were talking, I just went and looked at what they're estimating for earnings next year. It's only $8.22 per share, which is like, so per quarter that'd be an average of $2.05, which is lower than I'm expecting for Q4 even. So
Yeah.
I think you're right that Wall Street's just saying no, we're not going to give you any credit whatsoever
Yeah.
for those things. When we believe that you're capable of executing, then we'll raise our earnings estimates. And so when that
Yeah.
happens, they're going to have to raise their price targets, and that just you're going to contribute to this kind of a cascading string of catalysts. I think where you can't assume that Tesla's going to trade at like if you think, I don't know, just throwing a number in the air. Let's say you think Tesla's going to do earnings per share of like
Uh-huh.
$12 next year. Then at a PE of 100, they should be around $1,200 per share, like
Mm.
conservatively, I would say.
Yep.
And so I think you're going to see what same thing happened in 2020, where like there was just like this race of analysts kind of raising price targets and raising earnings estimates just because like they had to. It seems like a very similar setup right now to me.
Right. Yeah.
But
Is that like step change into earnings per share? Yeah. And by the way,
yeah,
what's your projection for quarter for earnings per share?
I think it was like 220. I want to say, I don't remember off the top of my head. Actually, I've got it
Okay.
here. Um, Yes. Okay. So 232.
Okay.
Possible I changed something in here since we went over the live stream last week, but that's what I have in here right now,
Okay.
which is a lot higher than the Wall Street consensus of, where is it here? A dollar ninety
Eight.
two.
Oh, yeah. Okay. Gotcha. And that takes into account some of the transfer and depreciation costs of the new factories.
Yep, a little bit. I don't think that's, like I was saying, I don't think that's going to be a huge um, impact. Yeah, I think that's going to be more of a drag on Q1 rather than Q4 personally.
Gotcha.
I think on the Q3 call, I think they were expecting those factories would have launched a little bit earlier. But I think the fact that they're delayed, of course, you're going to have some personnel costs and that sort of thing.
Hmm.
It's not like you don't hire anybody until like day one of production, so of course you'll have a bit of that. But I think Martin even said that on the Deutsche Bank report that the price increases that they have flowing through in Q4 are going to be greater than the materials increases. So he's
Yeah.
basically saying, if you read between the lines there, that gross margins are improving. Well,
Yeah.
maybe if you back out some personnel costs and startup costs for Berlin and Austin, maybe that cancels it out. But my sense is that the price increases are going to more than offset that, because they've had huge
Hmm.
price increases and such a backlog of orders that
Hmm.
those like price increases from like 3 months ago didn't hit in Q3. They're going to hit in Q4. So I
Yeah.
think we're going to have another positive jump in automotive gross margin this quarter. I think
Yeah.
it'll drop in Q1, but I think we're going to actually
Okay.
see an increase in Q4.
Gotcha. Yeah. Hey,
So we'll see.
that's music to my ears. So
It's not the gospel, but
yeah.
I hope it happens, and I think it's reasonable. Um, why don't we open it up to two questions now? I know I've seen a lot of comments come in. So Alec, if you wouldn't mind, let's launch a question here. All right, from Dan Mack. Some growth stocks have been beaten almost into value stocks. ARC favorite 3D printer NNDM cash value is $5 plus, but trades around $4. Teladoc is near its book value. Is the Good Soil team looking for value? Um, so, yeah, do you have any thoughts on that, Yashu? I'll share my thoughts as well. But
No, I don't. I don't really follow those stocks, to be quite honest. Very in depth.
yeah, so I don't follow those particular stocks very closely either. I'll tell you from the Good Soil. We've said this a couple times. Um, we're, I would say, somewhat bandwidth constrained, but we also want to have very high concentration in names that we feel we know kind of inside and out very well. And the current portfolio that we have, I think, falls somewhat into that kind of growth stocks beaten into value stocks territory. Lemonade's been hit real hard. Rocket Lab's down from its highs pretty significantly. Tesla's obviously down quite a bit from now, and for all the reasons we were just in the last 45 minutes that we were talking about, we think there's a huge amount of upside potential from here. So I agree with this trend in general. I was just looking at like the darling stocks from last year, like Zoom and Peloton, and those
Yeah.
are down like over 50%, well over 50%, I believe,
Yeah.
from their highs. So I don't, I haven't been able to research every one of these companies, to the extent where I've got confidence and cash to put into them. Just I'd rather kind of spend my time and um, put the chips in a couple highly concentrated bets that we feel we have more conviction on. But I think the thesis holds. All right, from Heinrich von Stahl. What do you think would be the impact of a 1% increase in interest rates would have on Tesla? Um, I'm not sure if that means macro interest rates or like Tesla's bound, like Tesla's debt. I would presume it means macro interest rates. Is that how you read the question, Yashu?
Yeah, I think so.
So what do you think on that?
I 1% is massive, right? That's one of those probably four rate hikes priced in 25 basis points each.
Hmm.
I think going thesis is about three. I think for next year is what they're saying. 1% increase in interest rates would definitely dampen valuations for sure. The question is almost how much of that is being priced in, given that we know that there's likely some interest rate hikes to come already. And so, if you're talking about discount value and discount rates, I think a 1%. Let's say if you did a nominal 1% increase, and I have to check my math on this, but if you did, till 2025 is kind of where I modeled to stuff. If you did a 1% increase in discount rate back from 2025 till today, that's probably like a 4% discount multiple. So let's say 4% hit off of cash coming from 2025. So I think it'd be decent for sure. The question is, I think the better question is, do we see a 1% increase in interest rates coming up? So, I mean, that's the question. That's the $1 million question with the rate hikes that are going to come next year.
So actually, this question reminded me of a tweet from Gary Black that I saw last week. So he shared a chart from Empirical Research Partners showing data back to 1952, which was a relationship between 10-year treasuries and the PE ratio of the S&P 500. And so basically, what he was showing here is that for an every 1 percentage point rise in the 10-year, PE would fall by 0.87 points.
Hmm.
So he ran the math on that and basically said, a rise from 1.5% to 2.5% would cause an approximate 4.5% decline in the market.
Yeah.
So that I think is a pretty reasonable math. Now for a growth stock like Tesla, where you've got a higher beta, I don't know what Tesla's beta is, maybe 1.5 or something like that. So I don't know, call it a
Yeah.
7% drop, somewhere in that neighborhood. To me, that's more than priced in already, and I think is dwarfed by kind of the operational catalyst coming next year that we were kind of talking about. So yeah, I think the impact is like we've seen some days where it rises or falls 7%. So it's
Yeah.
like
Yeah.
sure, maybe the macro environment, of course, it has an impact, but I kind of get the sense that like the sky is not going to fall if it goes to 2.5%, or like even 3.5% would be, pretty terrible. But like that's noise, I think, when you look at all the like the balance of all the stuff that's happening with the stock. All right. Age A says, can you guys talk about forward PE and PEG ratio for Tesla at this time and what analysts need to see in order to position their price targets accurately?
Hmm.
So I've got some thoughts on that, Yashu, but what
Go
about
ahead.
what about you?
You go ahead first. You're the
All
expert
right.
on this.
Yeah, so I think we talked a little bit about this already, where I think you can't talk about PE ratios unless you have a pretty good E estimate, right? So you need to have the earnings, and these are usually done on a forward basis. So I think my main contention is that the forward earnings estimates of like $8 and change are way too low for next year. So if you were to leave the PE ratio and the PEG ratio unchanged and essentially just say, okay, that it should be $12 rather than 8, then you've got a 50% increase essentially in your implied share price, assuming that you don't change the PE or the PEG. So
Hmm.
if that's the case, and just to make the math easy, Tesla's at 1,000, then Tesla should be at $1,500. Now it's not quite that simple, because if you're going to have that much growth next year, there's a case to be made that you should be using a lower growth rate going forward. So that's where the PEG ratio is a good indication. So if you think there's going to be 50% earnings growth and the PE is 100, then you've got a PEG of 2, I believe. So that's I don't know. I tend not to use PEG like as much as Gary Black does, because I
Hmm.
like to go a couple years out and look at things that
Yeah.
way. But yeah, I think what's going to happen is what we were saying earlier, where the E part of that whole equation is going to rise, and then that will even in a deteriorating macro environment, I think that's going to force some upward price pressure, unless it's like catastrophic macro market.
For sure. I take more of a basic approach, mostly because I'm not as educated as you are on this stuff. I look at 2025 as kind of my going standing point of, okay, how far can we project for deliveries? I think 2030, some people do 2030, and that's fair enough. But I just find 2030 too many variables, especially in that last 5 years from 2025 to 2030, for me not to be able to accurately project. And then when it comes to 2022, where I see a lot of people do, fair enough. I think we have the most information about the next fiscal year. I just find it too short term for me. So
Hmm.
2025, I kind of consider Tesla at the 50% CAGR to get 4.5 million vehicles delivered ish,
Hmm.
or in 2025. And around, I think my model is like a 50,000 average selling price, which is debatable, I know, and about a 20% operating margin at that, or that 20% margin on that gets us to about, I think, 40 or $45 earnings per share in 2025. And if you
Hmm.
apply, again, rudimentary, because I'm not that in depth on this sort of stuff. If you apply, let's say, a 50% PE ratio in 2025 to that gets us to about 2 grand, 2.5 grand, depending on your discount, or
Hmm.
two, depending on your valuation. And if you discount that back, I think that gets you to 14 between 1500 1600 ish bucks. And so up until we hit close to that, I don't really need to revisit a lot of this stuff, personally
Yeah.
speaking,
Yeah.
because it's just, we're 60% off of that, more than that at this point. And so when we were getting to the 1300s, then I was like, okay, let's start modeling more of this stuff out. Right.
Yeah.
But
Yeah.
even
Yeah.
then, that's just the auto business. We're not talking about
Right.
energy. We're not talking about Dojo. We're not talking about FSD, just the auto side of the business. So that's kind of the working model that, as someone that is not in depth into this as much as I probably should be, just keeps a loose kind of book on it. And then as we kind of approach that and get tighter and tighter, I think then it makes more sense for me to look into it deeper.
Yeah. No, that makes sense. So, we've been talking a lot about, earnings and kind of the way that I think about things from a modeling perspective, but you obviously look a lot at kind of technicals and, kind of market data. What are you seeing from there that, maybe someone who's not as experienced in it as you are, such as myself, might not be seeing? Are there any kind of indicators that you're getting from looking at that data that give you some insights in either short term or long term?
Yeah, I mean, with technical analysis, I always say like it's almost always short term. Yes, you can draw technicals and draw longer term trends to say what's gonna if it's fitting into this, it's form fitting into this model. I think Tesla right now speaking is pretty much sitting and pretty much rebounded right off of its 100-day moving average today of
Mhm.
880. Um, and so we're finding demand there, sitting there. The question is if it breaks below the 100-day is kind of the concerning thing to watch, is to see, okay, as we end the year, if Tesla breaks past the 100-day, then we're talking about it revisiting 800s, upper 700s again at just a
Mhm.
demand speaking level. So again, that's why I think around this level, and yes, in March and April and May of this year, we did see weakness back down to the 200-day. But I think what's different this time around, mixing technicals with fundamentals, is that we didn't have two new gigas coming out
Yeah.
within 30, maybe 30-ish days of from when this correction is happening. So, those are kind of the levels that I'm watching is 880
Mhm.
now, and a break below that and a close below that, then we're kind of talking into 800, low 800 territories again.
And as we're talking, we're rising up to,
Yeah,
918, so we're getting some good juju now. Appreciate
there
you
we
coming on
go.
the channel. All right, let's go to
Yeah.
the next question, Alec. All right, Melody of 1974 asks, if Berlin and Austin do get production ramp by end of 2022, do you see vehicle prices go down in 2023?
I
What do you
think
what do you think, Yashu?
I think Elon has said, Zach has said as much, that once margin starts it's to really skyrocket, I think instead of optimizing for profit, they're going to bring down ASP. Now the
Mhm.
question, like, this is kind of it's a really awesome question, because I think about it often, where we project for these margins 20%, let's say 2025. What's to say that Tesla just doesn't give back the cost and lower the margin and just grow delivery count? Potentially that's one way that they can go with their business. So it's a good question. With Austin, generally speaking, I guess the question is, does the EV tax rebate get passed? And if it does, then even if prices go down, that's not technically coming out of Tesla's pocket. I think what Tesla's careful to probably do is, if the Model 3 is, I'm not sure in US dollars, how much is it, Matt? A Model 3, like standard range
I
plus?
haven't looked lately, but I think it's like
Okay.
around 47, something in that neighborhood.
Wow. Okay.
So
So
on average,
that's
I mean, that's not the entry price.
okay.
I think that's like the average. I don't know.
Because
Maybe I should look that up.
it's okay. I got it here.
All right.
I think what Tesla probably is careful to do is to not, with the $8,000 rebate, bring the cost close enough. And I see it here; it's 39. Let's call it 40.
Hmm.
So with the rebate, get it to 32. I think they're going to be careful not to cannibalize perhaps their $25,000 model that is eventually going to be coming out. So I think they're trying to create this discrepancy between product price points at this point.
Hmm.
And so now, with the EV rebate not being passed, the big question I have as well with prices is that, do we see prices come back down? Because was that Tesla just pricing in the EV credit? And then now that it's not there, do we see a climbing of that back down? So,
Hmm.
but yeah, I'd love to get your thoughts on that.
Yeah. So Brett Winton from ARK Invest had this tweet like 2 years ago that has just been like burned in my memory ever since. You remember when Bloomberg did that like really extensive owners survey of like 5,000 Model 3s a
Right.
couple years ago. He collected a lot of the data in there and calculated the net promoter score, which is,
Mm.
basically how viral are these products, like how enthusiastic are owners about marketing them. And essentially, like the Model 3 was off the charts in terms of like how active promoters owners became. So it was like higher, significantly higher than the iPhone back in 2007,
Mm.
which is like kind of crazy to think about. So, I had that in the back of my mind and saying, okay, if that's true and if that holds over time,
Mhm.
then like the more Tesla sells, then the more Tesla should sell. And I think that's been happening. So even you've seen in an environment where production has ramped like quite drastically over the last 2 years. Even though that supply has been so much higher, your backlogs, measured in months, are higher than they've ever been.
Mm.
So I think that the dynamic, my understanding of just kind of what's going on here, is that that's the dynamic kind of playing out. That as awareness is continuing to rise, just from like I remember when I got my Model Y, like almost nobody that I interact with had ever driven in a Tesla, really knew anything about them. And
Yeah.
then like my brother ordered one after that. He had a different car on order that he switched his order to a Tesla. A lot of other people are just like, oh my gosh, this is so cool.
Mm.
So I think what you're seeing is now like more and more people are doing that. And so there's just kind of a rise in awareness. So if that trend continues to hold, then I think that backlog would maintain or potentially even extend even longer than what we've seen. So to me, that's the most important metric to watch as a gauge of demand is backlog at this point.
Yeah.
Because if backlog stays the same or starts shrinking, then that will give you an indication that I think price decreases are going to be needed to kind of sustain demand going forward.
Gotcha. Interesting. And I think the backlog in that Deutsche Bank report was 1.3 years or something, pardon me, for the model S and X, and it was like
Mhm.
8 months or 6 or 7, eight
Yeah, I think
months
it was like
for
6 months for
6 months
three and one. Yeah,
for the three and Y. So you
yeah.
like how far do you think that backlog would have to come down for us to start seeing price decreases again?
Like I think, I mean, 3 months is still a relatively long time.
Yeah.
But if it dropped to like 2 months or something like that, then that would have me maybe a little bit concerned. Because I think you've seen this in China to a certain extent, where like
Yeah.
there hasn't really been a backlog to speak of in China, but in Europe it's been crazy. It's been like over a year. So for whatever reason, it doesn't seem to be resonating in the same way in China as it is in like the U.S. and Europe. So I think it's important to kind of be realistic about that. So you could imagine there's a scenario where, Berlin ramps, and then you've got Austin, of course, ramping in the U.S. And so maybe there is some kind of point where there's a natural equilibrium between supply and demand at the current price point.
Mm.
So maybe they do have to start decreasing it. But I think when they get to that point, if it is say 3 months of kind of average global lead time, then maybe you start to decrease the price, and that will,
Mm.
I don't know, extend it to 4 months or something like that, which is still kind of ample.
Yeah.
um, but that's what I think we should be watching right now.
Sweet.
Let's do maybe one more question, and then we can wrap it up for this week. All right, Martin Muldoon says, "Would you prefer the EV tax credit go through or not? Seems like legacy auto desperately needs it." What do
Tesla's,
you
by
think
the
of
way,
that, Joe?
Tesla's flying on that news. 930, pretty much sitting on Tesla at the moment. So quite the rise from our stream.
Wow.
um,
I think
so
something
what I
similar happened last time I came on your channel. It was just
it
like
did.
a rocket ship throughout the day. So we should get together more often.
We should do it. Yeah, we should keep streaming until this stops. Would I prefer if the EV tax credit went through? Yes, I think I would, Martin, because I mean, yes, it's okay. Business strategy wise, speaking for Tesla, I think it's preferential for them if this credit doesn't go through, just for the sheer fact that they're probably the only EV provider that can make EV cars at cost or more than cost and make a profit, and not just at cost or less than. But I care about the EV industry, I think, greater than, because I think 1+1 = 3 in this industry. And I think in 10 years' time, we want competition pushing Tesla. We want more entrants into the market. So I think, is it and again, as I'm not American, so I can't speak to the tax consequences that you guys might have based on this EV tax credit. So I'm not one to pontificate on it too much. But at the end of the day, I think whatever pushes electric vehicles to proliferate in the market, I think is better for the climate, for the world, and just a better consumer experience. So do I want it to get passed through? Yes. Does it legacy auto desperately need it? I think so. And that's why I think we'll probably have some sort of news on that in quarter 1.
Yeah, yeah. So speaking for myself, I'm really torn on this, to be honest with you. So I'm a Michigander, so actually got a lot of
Hmm.
almost all of my friends and family actually work in the auto industry. So I like I kind of selfishly, want them to not lose their jobs, and like
Yeah.
my whole community not to like fall into ruin. But I do think that there's a reasonable chance that that happens if they don't, you know, drastically change their business models. Um, so I think if I could vote on the EV tax bill going through as like a standalone item, I would say absolutely I support that. But when it gets kind of mixed up with the like a broader multi-trillion-dollar package, after we've already passed several multi-trillion-dollar packages and we're running 70% deficits, and we've got debt at 120% of GDP or whatever it is right now.
Yeah.
I think these are structural issues that we are not talking about, that we don't really have a plan to tackle, and that are only going to get more aggravated just with kind of current trajectory of spending. So, as like a relatively fiscal conservative, I would prefer that they not do things like this. But at the same
Yeah.
time, I do think that this one credit does have merit, and I would support it. And I think it's the goods of the tax credit in general outweigh the bads on a standalone basis, I think.
Makes sense.
So
Yeah.
yeah, but I don't know. I won't be heartbroken if it doesn't get passed, and I won't be heartbroken if the whole BB bill does get passed, because it's like anything that there's trade offs. It's not like there's
Yeah.
one perfect answer that's going to solve everything and make your stocks go up and make the deficit go away. That's not generally how it works.
For sure. And I think I guess for you almost want some of these automakers to succeed just with EVs, because if they can
Yeah,
see the light and they can see like, look, we can do good and we can also make these amazing cars, debatable if they're amazing, but at least they can move forward. And I think that's better for everyone rather
yeah,
than just the old. I think Elon probably considers probably a similar strategy where he open sources all the patents, and he's
yeah,
welcomed people to come by and to look at the tech, and Herbert Diess is an example. And so I think it's better for the world, because in a world, because we've already seen the EV killed once by GM. We don't need to, and debatably twice with the Bolt, but we don't want to see it. We don't want to see a world again, right? Where at the end of the day, when we can bring everyone up and forward rather than to potentially kill the
yeah.
market.
Yeah,
So
I think it's important to remember, like even Elon says, like Tesla can't do this alone. I mean, there's going to be a second place and a third place in the EV market, and probably a fourth, fifth, seventh place. So there's
yeah,
ample room for, whether it's startups like Rivian, or other companies out of China. There's a lot of them doing really well there. Or if it's the legacy players, like Ford and GM converting and successfully playing the game. Either way, I think we want more EVs to be sold, and less ICE vehicles, and it's kind of an inevitable outcome anyways. So what can we do to kind of accelerate that transition? I think that's the thing we need to be focusing on.
absolutely. Yeah, for sure.
All right. Well, hey, thanks everyone for watching. Thank you so much, Yashu, for guest hosting with us again here this week. What are we at now? 9:32 last I saw. So some real good
9:32. Yeah.
juju,
Yeah,
real
we
good
actually,
juju this week.
yeah, we
Rose about $30 in the hour or so that we've been talking.
crazy, crazy, and we actually hit 9:36:60 on the stream. So there's that. Wow,
Did we?
amazing time.
Yeah, we should have had a donate button or something like that. um,
Awesome.
well, thanks so much for watching. I think Emmett's gonna be back with us next week, so we'll get back to our normal live stream. But thanks again, Yashu, for joining, and thanks everyone for watching and listening on Twitter Spaces.
Right
Take
on.
care.
Thanks for having me, Matt. Take care.
Yeah.